I'm Yahoo Finance Executive Editor Brian Sozzi. You're taking a look at a live shot of the opening bells on Wall Street on this glorious Monday morning. Finance of America companies ringing the bell at the New York Stock Exchange. Getting things underway at the NASDAQ. Now the markets are attempting to settle down a little as August trading settles in and temps remain hot. But Friday's surprisingly weak jobs report, which included 258,000 in downward revisions, has investors on high alert. Bets on a September interest rate cut are on the rise, and fears of a sharp economic slowdown this fall are front and center. Goldman Sachs economists are already out this morning warning of a very sluggish consumer spending backdrop into the end of the year. This as earnings continues to roll right along. Earnings season, I should say. Key results out this week from momentum tech names and Palantir and AMD. Now, opening bid is all about serving up investing analysis you need to know to unleash the power of your portfolio. We're digging into what's really moving stocks, giving you the unbeatable context to make decisions with all of that money in your portfolio. Let's get down to the NASDAQ in Times Square and check out Yahoo Finance senior reporter Brooke DePalma. Brooke.
Good morning, Brian. Taking a look at the YF Interactive, which is just loading in this morning's latest headlines as we make way into this week's trading session after that week of just so much data coming at us, as well as those earnings reports. We're seeing all three major indices open in the green this morning, led by this a bit of an uptick of 0.9% by the NASDAQ, really Tesla leading that. If we take a closer look at the NASDAQ breakdown here on the YF Interactive, we're seeing Tesla leading a bit of those gains. Shares now opening about up 1% after we got that latest headline on Tesla CEO Elon Musk's pay package. And what we're really hearing there is this optimism among the street is that this is what investors needed to hear to keep Elon Musk focused. We know that that stock has been under pressure year to date as investors feel as though he's been pulled away from the company, that his focus and attention isn't there. That pay package will take and keep Musk until 2030, and many analysts on the street saying that that sort of removes the overhang or overhead that we've seen on the stock as of late. Also worth noting that Microsoft, after that key earnings report out last week, also moving higher after we saw a bit of a drop last week after it wasn't as impressive as others, or rather Apple also holding on a bit to that momentum in early hours, up about 1.5% here. I also want to do, if you take a look and take a step back, we did get some major headlines from recent trade negotiations out last week. And while we're seeing a bit of this rally, important to note here now, the NASDAQ up 1%. Some of those more aggressive trade headlines, like the tariff on Switzerland of 39%, did get attention among investors. And now we're seeing Swatch Group. That's a key company from Switzerland. Of course, they make luxury goods like those key Swiss knives. That stock under pressure this morning. You're seeing shares down about 2.5%. Swatch CEO calling for these tariffs to go down, ultimately, emphasizing this will impact the business. And it's important to note that headquarters in Bern, Switzerland is not only a key player within the economy there, but of course they ship to globally at large, especially here in the U.S. So once again, hoping that 39% tariff is cut. That's putting some pressure on the stock today.
Brooke, I may have to go back to those cheaper fossil watches if Swatch hikes up those prices. Brooke DePalma, thanks so much. All right, we're kicking things off with your daily guide to the biggest market drivers of the trading day. Here's what I'm watching. Number one, is it time to dust off the Sell America trade? Investors are on edge after a terrible July jobs report on Friday, which contained 258,000 in downward revisions to prior months' jobs data. With markets still hovering around record valuations, pros say it may be time to lighten the load on U.S.-centric stocks, such as those in the Magnificent Seven. Number two, the summer of the Fed continues. Bets on interest rate cuts are on the rise after the poor jobs data. So what's the play here? On the one hand, rate cuts are often good for stocks. On the other hand, the economy looks to be slowing under the weight of tariff uncertainty. We'll dive into all of this. Number three, electrifying Elon's bank account. Tesla said this morning in a new filing it has granted CEO Elon Musk 96 million shares worth about $29 billion. It's a move aimed at keeping the billionaire entrepreneur at the helm of Tesla at least until 2027. The question is, believe it or not, is $29 billion enough to appease the outspoken Musk? Wedbush analyst and Musk critic Dan Hives says the award could keep Musk leading Tesla until 2030. My roundtable for today, Thomas Hayes, Great Hill Capital Chairman and Managing Member, and Yahoo Finance Senior Reporters Brooke DePalma and Inez Ferre. Tom, $29 billion. Not bad, right?
Not bad. This is a true up. It's interesting. The board said that we needed to give him this grant to keep him focused on Tesla. He's got 13% of a $1 trillion company. That's 130 billion, round numbers, close to half of his net worth. I don't know that he needs that to keep him focused on Tesla, but maybe they need to keep him in the picture. And that's exactly what they're doing here. I mean, with the EV tax credits going away, you're seeing the big three pivot away from EVs towards hybrids. And ex-Chinese EV companies, I think Tesla is going to be the last man standing. And they do need Elon Musk, and they do need to pivot the company towards humanoid robots and towards robo-taxis for it to continue to grow into its current valuation, because the EV numbers haven't been great, and they're not going to get much better.
Thomas, what bothers me about this is, so Elon may stay until 2027, Dan Ives thinking 2030, yet we still have no clear plan on succession. Or am I wrong to care about that, or does it even matter as Elon Musk still is driving the story? No pun intended.
I think it's another equity grant in 2027 or 2030. Look, Tesla is Elon Musk. Elon Musk is Tesla. You take him out of the picture, all of that premium goes away. He's the innovator. He's the guy who slept on the factory. He's the guy who took it out of bankruptcy. He's the guy who got the government to give him all the subsidies. Without Elon, candidly, I don't think there is a Tesla. So they got to give him what they got to give him to keep him focused, to keep him staying, to true up what he was already promised in 2018 and what he delivered on in terms of performance. So to be continued. He'll be getting more stock to keep him in 2030, that's for sure, unless the humanoid and the robo-taxis takes off on a life of its own that it's so spectacular it doesn't matter who runs it. You know, Buffett said, buy a company that's so great that even a ham sandwich could run it, because one day a ham sandwich will run it. Tesla is nowhere near that point, but maybe if the technology is strong enough 4 or 5 years out, we could have a different conversation.
And as maybe that conversation is maybe the thing or the person or whatever it is that succeeds Elon Musk, maybe it's just one of his robots. Maybe that's what we're looking at here.
Perhaps it may be. I mean, I think that Tom has a point that Tesla definitely is Elon Musk. This is a company that's run by a bigger than life sort of force, so to speak, when it comes to Elon Musk. And he's running other companies as well. I mean, if you take a look at Neuralink, SpaceX, putting internet access in remote areas. So really, when you're looking at Tesla, you are also looking a bit at, we've seen Tesla be sort of a cultish stock, so to speak, throughout the pandemic. I think that continues because you are betting on Elon Musk, and it's kind of hard to bet against somebody that is leading so many other companies as well. It's interesting that this compensation comes sort of as it's kind of doubtful that he would be leaving Tesla, right? I mean, when investors think about Tesla, you don't really necessarily think that Elon Musk would be leaving the company, so to speak, because he is spearheading this new direction towards these robots, towards robo-taxis. I mean, it's a clear pivot that the company is doing, and you don't imagine anyone else leading it but Elon Musk.
Or maybe that robot, Inez. Let's just be honest. That's where things may be headed here. I mean, you have to probably pay this robot. Thomas, I want to get back to you because I kicked off the show on talking about the likelihood of the Sell America trade coming back in force after that weak jobs report. Now, I think about Tesla, a U.S. company. Of course, they have operations overseas. They make cars overseas, but really known for their U.S. operations. What is your view on the U.S. economy off of that jobs report? And if you are concerned about the economy, where can we start seeing weakness in terms of U.S.-focused stocks?
Well, I do think that the Sell America trade, for lack of a better word, is alive and well. I mean, if you look at performance year to date, equities ex-US are up 16% and change, 16, 17%. S&P up 6%, so 10 points of outperformance. I do think that there's a lot of spend going on with Magnificent Seven. We saw some kind of mixed results. They were good. Earnings growth was about 14% for Mag 7 that has reported, but that's down from 33% earnings growth last year. And next quarter will be the first quarter that earnings growth for Mag 7 actually goes below 10%, but the multiples haven't contracted. So if you look at Amazon, 31 times PE, with low double-digit earnings growth. You look at Microsoft, 31%. 31 times PE with 8% earnings growth. So you're seeing the earnings growth compress as they spend more and more on CapEx. We're waiting for that return on investment, but the multiples haven't contracted yet. So I do think with the weight of the Mag 7 in the S&P 500, you're going to continue to see some international outperformance in the back half of the year. The other thing that we've seen in the last month and a half has been two themes: smaller and high short interest has outperformed the S&P 500 by 11 full percentage points in the last 6-7 weeks. And I think that's going to continue. And the reason is all dips have to be bought. So many managers sold in the hole, over $1 trillion of equity selling in the beginning part of April, and they haven't caught up to their indices. So they've got to chase that performance, and they can't chase what's already up a lot. They've got to buy those things that haven't yet moved, and those are largely smaller stocks, which are the most shorted right now. And if you look at earnings growth for next year, small cap earnings growth is going to be 37% versus the S&P 500 earnings growth expected to be about 14%. So you basically get more than double the earnings growth for a lower multiple. And I think that's where things have to go. And things are going to go that direction as rates come down. I think now the writing is on the wall with the jobs report that you referenced. The Fed has to move, and the Fed odds are up to 87.4% of a cut in September. Look for that pivot at Jackson Hole in August.
Brooke, and we have a big anniversary celebrating markets. If you follow markets, you love data. I mean, here's one. Just get that. Let's get that confetti popping all over the screen. Not if we're sure if we could do it, but you know what I'm saying.
Yeah, certainly a big anniversary indeed. It's been 5 years since the 10-year U.S. Treasury yield hit an all-time low. Deutsche Bank pointing this out in a note this morning, emphasizing that the past 5 years, he said, has simply corrected a chronic overvaluation in bonds. Now, since then, what we've seen over this past 5 years is the 10-year Treasury hitting the worst 5-year return on record. And he pointed out that it actually hasn't seen this sort of return since, get this, the 1790s. And what we really know is that the 10-year Treasury has been a bit under pressure. We're seeing it fall slightly this morning as investors really try to understand those tariff rates that President Trump just put into effect, but also this fear about where exactly the U.S. economy is headed as all these headwinds are up against not only the consumer, but then we're also seeing actually AI lead the U.S. economy right now over consumer spending. And so there's lots of, fear within the air. But what we've seen is this 5-year return be the worst on record. We also know that it's been 5 years since that August 4, 2020 date where we hit that all-time low, down about 0.5%.
And as based on, just thinking about what Tom just said, I am fascinated to see if investors come in here not only today, tomorrow, or even the rest of this week, and they buy that dip we saw on Friday.
Yeah, and Nomura had put out a note basically talking about the sell-off on Friday and just saying that it was a bit of profit taking. There wasn't a follow through, so you could be seeing more dip buying. I mean, we haven't had these kinds of those kinds of days for a while now. So it is interesting to see if investors are also pricing in the fact that we had that weak jobs report and those revisions down. So this may be also the market getting the clear signal that the Fed will have to cut in September. And it'll be interesting to see if Powell gives a big hint about that at Jackson Hole.
Indeed it will. Thomas Hayes, Brooke DePalma, and Inez Ferre, thanks for hopping on my roundtable for today. Straight ahead on Opening Bid, should you buy the surprising dip in semiconductor stocks? Citi says yes, I have that in my call. And in my Power Player segment today, we welcome on former Commerce Secretary in President Trump's first term, Mr. Wilbur Ross. Welcome back to Opening Bid. I'm keeping a close eye on the Philadelphia Semiconductor Index, or the SOX, a lot easier to say, which has tanked about 6% over the past 5 trading sessions. The action is interesting in the sense AI players such as Microsoft and Alphabet had strong second quarter earnings reports and hinted at more aggressive CapEx spending ahead. But Citi says the SOX is under pressure due to weak earnings results and outlooks from Texas Instruments, ASML, Qualcomm, and of course Intel. The sell-off could alleviate slightly this week, Citi says, as results out of AMD and Microchip are expected to be much, much better. All right, the Trump administration continues to work on securing trade deals with key partners, most notably China. Recent ones have included slapping the European Union and Japan with 15% tariffs on imports. Meanwhile, President Trump's 39% tariff on goods from Switzerland is among the world's steepest and came as an unwelcome surprise for the country. So what's next on the trade deal front? I want to welcome back onto Opening Bid longtime investor Wilbur Ross. Mr. Ross serves as the U.S. Commerce Secretary in President Trump's first term and has had a close relationship with the president for decades. Mr. Secretary, always nice to get some time with you. Appreciate you coming on here. Before we get into the topic of trade, I'm sure you've seen what's been going on with the president dismissing or firing the BLS commissioner. You know, you're a longtime investor. Do you still believe that the economic data coming out of the government?
Well, I think what is a little bit suspicious about the most recent BLS data is it came out shortly after the Fed FMOC meeting where Trump was hoping to get rates reduced. And clearly, if the two big revisions had come out before the meeting, it would have been more likely that the FOMC would cut rates. And that's the second time that that sort of suspicious behavior occurred. Remember, just before the presidential election, they also had 2 months of very good labor results. And then a day or two after the election, they made a massive correction in both months. Again, had that been out before the election, it would have been helpful to Trump. So I can understand why he would be suspicious, at least of the timing. As to whether the underlying data themselves are correct, I would really have no way to know. But it is a little spooky that there were two recent events, big numbers, big changes that could have helped Trump had they been more timely.
Do you believe, Mr. Secretary, before we get into the trade, like the president noted on Friday after the numbers were hit, that this data is rigged, not only the jobs data, but perhaps other data that the government provides?
Well, I think that's just speculation. He certainly never tried to influence the data that came out of the Bureau of Economic Analysis, which is part of Department of Commerce. We never had any problems like that during my term. But we also never had the kinds of events that I just described to you that naturally make one a little suspicious.
Mr. Secretary, on the trade front, since we last talked, tariffs have stayed in place for many countries. I mentioned Japan at 15%, Switzerland now at 39%. Are tariffs the new normal for the duration of the president's second term here, in your view? Or is there an opportunity to take these 15% tariff rates that Japan is now paying and negotiate them down further?
Well, I think the president has made clear that if there are further reductions by other countries, that he would take that into account. So his target is really improving our balance of trade. That's one of his major objectives. And that can either be done by holding back the trade of foreign countries through tariffs or by everybody cutting it together. So I think trade policy will continue to be a centerpiece of his administration, but that doesn't mean everything will be increasing.
What gets a deal with China over the finish line?
Well, China, as you know, is going to be having their big party Congress very, very shortly. And as you may know, I've felt for some time that it was unlikely that they would make a radical change in policy before the party Congress. They don't normally do that. And I think that Congress is either this week or next week, so we should know pretty soon if anything different will come out of that. But certainly the news that was out today about the critical materials being still restricted, that was not very encouraging.
Mr. Secretary, the fact that China has not solidified a deal with the U.S. on trade, is it likely then that its tariff rate will be higher than what we saw from the likes of Japan and, of course, the European Union?
Well, it's up pretty high right now, and it's I don't know whether he would make it even higher, but once you get to about 30 or so % on the tariffs, it doesn't make too much difference if you go beyond, because 30-odd% is very, very hard for a country to absorb. And as a result, 30 or so % is the demarcation between, are you going to be doing trade with them or not?
Mr. Secretary, you're back in the news for another reason, more back on investing for a change. Tell us a little bit about the SPAC you're sponsoring in IROC and what it does and why are you interested in doing this?
Yes, when I finished my term at Commerce, I started a SPAC along with 2 other people who had been partners of mine at WL Ross & Co. pre the administration. And we indicated that the SPAC had a broad range of possible targets, one of which was space. And we now have found what we regard as a very good opportunity in space, and that's iRocket. I think you've seen the press release that they just put out this morning about a new letter of intent for Saudi Arabia for $640 million to take care of around 30 launches. So that's a very big development because they're not yet in the revenue stage. So getting a letter of intent that big from a major civilian entity is very good. And what their product does is the following. You'll remember that Elon Musk's great innovation at SpaceX was having the lower section, the launch section, be retrievable. That actually lands very close to the original point of departure and is reusable. But under Musk's SpaceX, the upper section is not retrievable. These fellows have developed a way to make both sections retrievable. That's a tremendous saver of money, and it also is very, very useful in terms of how quickly you can get the rocket back into service. They can turn it around within 24 hours. And the reason our military has been largely funding this company until now is that they can not only launch communications satellites, they can also launch drones. Mm-hmm. So you could have a situation where in a war-fighting environment, mm-hmm. we're launching drones from both ground level, which is where they normally have been, all the way up to hundreds and hundreds of miles into space. So it would make it very difficult for the defenders to be able to fend off drones mm-hmm. if they're coming from every kind of a different direction.
We look forward to continuing to follow the progress on IROC. And Mr. Secretary, always nice to get some time with you. Appreciate you coming on. Of course, the Secretary is the author of the book Risks and Returns. We'll look forward to talking again soon. All right, coming up, Julie Hyman will bring you the news behind the market moves for the trading day on Market Catalyst. Stick around.